Hello, this is Dale. I have more than 35 years of experience as a professional stock investor and hedge fund manager. During my journey, I've learned a lot of insight into how to become a success in the market. Today's lesson is entitled, "Which is better, to be a buyer or seller of options?" Both have advantages and disadvantages. What I want to do in this webinar is go over the advantages and disadvantages of both and let you decide what makes sense for you. If you're a buyer of options, the advantage is you have unlimited potential gain. And you're limited in your loss because you can't lose any more than the option premium price that you paid. An example is if you have an option in Apple, and it goes in the direction you think it is, by the amount you think it'll move, within a certain time, you may have unlimited potential gains. That's the advantage. On the other hand, let's say you buy an option for a price of about $5. $5 times 100 shares per contract equals $500. That's the maximum you can lose. There are, however, 3 ways you could lose, or the 3 disadvantages. One is you have to pick the right direction. Is the stock going to go up or down? Not only do you have to pick the right direction, you have to pick the right distance or magnitude of the move. Finally, if you have those 2 correct, you have to be correct on not only the direction and magnitude, but you have to do it before expiration. If that move does come to fruition after the option has expired, it's worthless to you. Actually, picking the right direction is extremely difficult. An analyst who does this full time and is paid handsomely for it might do nothing but study a certain company for years. They know the business inside and out. They can still pick the wrong direction for a company's stock price. Now, do you have that edge? The ordinary investor has access to none of that information. You might see their financial statement or look at their balance sheet, income statement, statement of cash flow, and say, yeah, this company looks pretty good. Remember, you're doing that at a glance. The analyst has a fundamental edge in the marketplace. You don't. You may be an excellent technician. You can gain an edge that way. Regardless, picking the correct direction is crucial for the option buyer. The second disadvantage is the option buyer also has to pick the right distance or magnitude of the move. If he buys an option believing that Apple stock is going to $220 per share, and it's sitting at $200 per share, what he's buying is something that is out of the money. That option has premium associated with it based on time value only. Apple not only has to go in the upward direction, it has to rise at least $20 per share to get to the point where you're at $220 per share. If it goes to $210 a share, this would be an example of getting the direction right, but the magnitude wrong. Now, additionally, not only does the price of the stock have to reach $220 per share, but the buyer also has to include the price of the option they paid. Let's assume about $5 as a premium on that option. Now, not only does the stock have to go to $220 per share, it has to go to $225 per share for you to even break even. Then for you to make money, it has to go beyond that. You have to be correct on the direction, and you have to be correct on the magnitude. Finally, if you get those two right, you have to have the move occur before the option expires. Let's say you go out about a month or two and put on the trade. And it moves, and the move comes to fruition 4 months down the road. You're going to lose everything. The greatest difficulty the option buyer has to contend with is time. Correctly picking the direction and magnitude with the strength of the move is worthless if the target is met after expiration day. Now here's a caveat. Sometimes the market moves quickly and it moves in the direction you called for. It doesn't have to have all the magnitude. There is a chance that if it moves quickly in your direction, well in advance of the expiration date, you'll make a profit if you quickly close the trade. The problem with that is you have to be right on top of that trade and close it at the right time. Each day that goes by, a little more value is lost in the option. That's commonly referred to as theta decay. Say you have an option out around 90 days before expiration. For a while, you're not going to have a lot of theta decay. However, in the last 30 days, that theta decay becomes exponential. What that means is that you bought an option that has a premium of $5, and if the stock hasn't increased in price the last 30 days, that $5 evaporates quickly. You can see that buying has the advantage of limited risk but unlimited profit. That's why a lot of people are pulled into being buyers of options. That's why a lot of people are pulled in. Yes, you can make money if it quickly moves in the direction you're looking for. However, if it slowly moves in that direction and slowly gets to the magnitude you'll need, and it takes too long, you're going to lose. There are three things really working against you. Let's look at the odds of being correct. Let's attribute 50-50 odds to correctly choosing each of these elements, which, by the way, is probably better than you can actually do. If you took a coin and flipped it and said, heads, I'm going to buy a call, which is a bullish play, and tails, I'm going to buy a put, which is a bearish play, you'd have roughly about 50-50 chance of being correct. Picking the magnitude of that move is even harder than 50-50, but for this example, I'm going to give the benefit of the doubt and stick with that 50%. If the move's going to happen before expiration, I'm going to give that 50-50 odds too, which I think is generous for both the distance and time. Mathematically, if I take 50% times 50% times 50%, I get 12.5%. At best, the odds of holding a profitable option at expiration are about 1 in 8. You may think you have an edge, but study after study show you really don't. Let me just go back and say that if you're a buyer and you do choose the direction correctly and it happens quickly, you may profit handsomely, and that's what pulls people in. Other than that, the odds are against you that buying options is a good long-term strategy. Let's look at the seller. The seller has advantages and disadvantages too. The seller only has to be right about time. If you're wrong about time, your losses can potentially be quite high. The advantages of the seller is you only have to be right about time. You don't care if the direction works against you or even about the strength of the move. You care that time works for the trade. The worst your odds are is 50-50 because time will either work for you or against you. It appears like the odds might be better off by selling than by buying. The disadvantage, however, with selling is if you're wrong about the time, you potentially could lose a great deal. Here's a chart. I took a screenshot from Thinkorswim. I'm not affiliated with Thinkorswim. Happen to think that they're a very good trading platform. Their charts are easy to read and you have a lot of charting tools available. What I'm looking at here is a daily chart of the RUT, the Russell 2000. The price of the Russell 2000 was going up. Right about here you say, well, I think that the price is going to continue to go up and I'm bullish. If the RUT price goes up, I'm going to capture all the premium if I sell. If the RUT price goes sideways, I'm going to capture all the premium. If the RUT drops, but not more than the strike price I sold, I'm going to capture all the premium. You've got a very large profit zone. However, if the price drops drastically out of the profit zone, you may have unlimited loss. The risk reward of selling looks terrible because, like I said, you've got limited returns for unlimited risk. Enter credit spreads. A credit spread is simply selling an option at a certain strike price and then buying one further out of the money for protection. A spread is simultaneously opening of two or more option positions that offset one another. The setup is short selling calls or puts and simultaneously buying a call or put further out of the money. The most important attribute of any spread is that it can reduce the risk. If you trade a spread, you can mitigate some of the risk that you have involved with the offsetting long position. If you go one step further and say, I'm never going to let the spread go all the way to expiration, technically, if it moves against me, I'm going to get out. You can mitigate your risk even more. I hope you enjoyed this webinar on whether it's better to buy or sell. I think you guessed it. The next webinar is going to be on demystifying credit spreads, either bull puts or bear calls. If you have any questions, please go to the website. Click on Contact in the upper right-hand corner and send us a message.